In this video, we're continuing our Seasonal Strategy Blueprint series. This is a framework designed to show how different trader types can use seasonality in practice, not just theory. So today we're focusing on a very specific and highly active trader type, and this is the economic surprise trader. This is the trader who focuses on major economic releases, central bank decisions, and the market's reaction when reality diverges from market expectations. What we're going to look at here is how seasonality, and specifically event-based seasonality, can be used to manage expectations, targets, and risk around those events. So first of all, let's define the economic surprise trader first. Now, an economic surprise trader typically trades around high impact macro events. Generally speaking, they're less concerned with long-term trends. They focus on reaction, volatility, and repricing. And they care deeply about the magnitude of moves, not just the direction. So this trader is not just asking, will the data be good or bad? What they're asking is, how far does the market I'm looking at typically move when the surprise is meaningful? And this is exactly where SeasonAx's event feature, which I've got highlighted here, comes in extremely useful and very powerfully. So what most event traders rely on is consensus expectations, volatility assumptions, or recent price behavior, right? So if we just quickly go and have a look at what the economic event surprise trader is looking for, they'll be looking at the baseline of what's expected, and then they'll be noting what the surprise is. Now, often what helps an economic event trader find the surprise is the consensus of economic expectation. So for example, say US CPI is coming out, say it's expected to be year on year, 2.4%. There'll be a range of expectations. So some analysts expect it as high as 2.6, some analysts expect it as low as 2.1, the consensus will be a 2.4. So the surprise is something that comes outside the range of expectations, right? And then the economic event trader is asking, well, has this changed the bigger picture? And obviously, if you get a event that is a surprise and then changes the bigger picture, then you get the biggest moves. So the problem that the economic event trader has is they don't often know what a normal move is for the event and what an extreme move is for the event. When does the market usually overreact or fade? And without historical context and seasonality, traders tend to either set unrealistic targets, or they're just setting arbitrary targets. They could be placing stops too tight or too wide, or they could be misjudging post-event follow-through. And event-based seasonality provides that missing statistical anchor. So one of the most valuable features of SeasonAx's event feature is expectation setting. So by analysing historical reactions to central bank decisions, you can see here all the range of events we have. Central bank, all these different central banks, elections, US reports, CPI, non-farm payrolls, GDP, non-US reports, GDP out of UK, Japan, Germany, CPI, UK, Japan, Germany, Euro area, and as well as miscellaneous events, some major commercial airline accidents, sort of surprise events, holidays. All of that's very helpful for the economic surprise event trader. Now, what you can do here is you can set your event. So let's say we're looking here at the S&P 500, and we're looking at the S&P 500 around the Federal Reserve interest rate decision day. And what you can see here, just by highlighting, this is the day of the decision. Now, straight away, you can see what the average move is in the S&P 500, right? You can see the maximum historical move, look, 2.99%. You can see the maximum loss, the downside, 11.98%, right? That's obviously COVID years. And you can start to see the maximum range of the whole move. So, okay, here's the the profit was 1.09%, and no downside in this Fed decision. Or you can see, let's have a look here. Because it's quite directional, isn't it? That when price is moving up or down, it tends to continue in that direction. Okay, so it's quite a directional move, which is really helpful to see. 2016, the max, you can look at the maximum gains and falls. You can see that markets tend to finishing on their highs and lows of that day. So that's really helpful, isn't it? The markets tends to finish on its highs. That's the maximum rise. And look, the maximum rise and the profit tends to be the same. So straight away you can see, okay, on a Fed day, what you're tending to see is the market move quite firmly in one direction. And then you can see, what about the 2 days after the Fed decision? Okay, you can see the average return, 0.23% over the last 10 years. And again, you can see some pretty helpful data points showing you, here, for instance, when the move was negative 0.97%, it was as high as 0.8% positive. So you can start to see the maximum moves and gains that there actually was, right, during the session and during that period. So very helpful in terms of setting your range of expectations. So that the next layer that the seasonality traders looking for the events is target selection, right? They can anchor profit targets to historical reality. So let's just go and take the euro dollar, for instance. Okay, we'll look at euro dollar during a Fed meeting. And straight away you can see on the day of the Fed meeting, right, like the maximum returns, you can see here, the maximum return has been up 1% plus. So that will tell you straight away that if ever, right, you had a reason to enter the euro dollar pair, and on you're looking for an intraday target, 1% is kind of the maximum you could look to expect. The maximum profit is 1.24%, and the maximum loss is 1.25%. So that tells you straight away that if you were looking at a target at 2%, either that target is not going to be hit intraday, so you need to change it, or it's a target that might be hit over a number of days, right? So you look at out of the event, 3 days out of the event, you see, okay, then you're getting close to that 2%. So straight away you can see that if you're trading the event itself, a 1% gain or a 1% loss is a reasonable take profit level, and in fact is around the maximum of what you can expect. So as soon as you're starting to get to 1% move, either to the upside or the downside and a surprise, you're coming close towards the end of your intraday expectation, right? Based on the euro dollar on the Federal Reserve meeting over the last 10 years, right? You can also, see this for 5, 6, 7, and any number of days that you want, and that can help set your expectations. If you're potentially wanting to hold the trade, the surprise is so big it changes the bigger picture. It starts to let you see, okay, if you're looking to hold it for 5 days, see the maximum fall here has been 4.15%, maximum gain 2.62%. So this is how seasonality turns reactive trading into structured trading. Also helps you very much so with your stops, okay? Because you can see here that if these are the maximum returns, you might think to yourself, well, I need a 1% stop on this, because that's kind of the maximum range you tend to get. So if I'm in the unlikely event you're completely wrong on your analysis, you can know that an adverse move of about 1% would be towards the maximum of what you can expect on the day. So event-driven markets, they are volatile by nature, but you see, what Seasonax helps you to see is that not all volatility is random. And Seasonax allows you to study the typical adverse excursions after events. You can begin to get a sense of the maximum rise and maximum drop of the total move. That's incredibly helpful. And that can help you avoid stops that are too tight for event conditions or stops that ignore historical behavior. So it's not just targets that can be looked at, but also stops. Now, another key insight from event seasonality is what happens after the initial reaction. You can see, some events, they trend for days and the move carries on. Others mean revert quickly, consolidate after the first impulse. And by using this historical event path, you can decide, do you want to hold a position? Is it making sense to fade an extension, or whether to step aside entirely? And this is critical for traders who don't want to confuse volatility with opportunity. So you can see, when used properly, event seasonality gives economic surprise traders better expectation management, more realistic targets, smarter stop placement, and you're less likely to make emotionally driven decisions. It doesn't predict the outcome of the data, right? It just prepares you for the range of outcomes. And this distinction is crucial. So the economic event trader will still be using significant skill in order to look at the baseline, to recognize a surprise, to see if it changes the bigger picture. But event trading is not about guessing the data. It's about understanding how markets historically react when surprises occur. And Seasonax helps you to quantify that risk before the event and trade volatility with structure, not just blind hope. So if you trade economic releases or central bank decisions, I strongly encourage you to explore this inside Seasonax and test it for yourself on your own market, because the goal isn't to predict surprises, it's to be prepared for them.